Yo, what's up, everyone? We're going to go over this new play terminal that you can use throughout the day to find play opportunities. And I'm going to be expanding on this, obviously. Now that we're in the new server, everything's kind of clean. We can just start building it up how we want. I have the sec feeds going right now for company earnings and things like that. So whenever these come in, I'm going to add in a feature that we're going to use GPT to automatically analyze these and give us a summary basically that we can put in the database and then call upon any time that we want using the Discord commands. So that's how it's going to basically work in the new server, is that all of the channels are going to be storing the data in real time, and then as it's being stored, it's also going to be sent to the database in the back end, and then from there we can use the database information that's being updated in real time to query things with bot commands. So as far as the play categories that you can have to choose from, all you got to do is to get the terminal open, do F2, and you'll see /plays F2. And when you open it up, you're going to get a little menu that kind of has the play type, and I'm going to go over each one of these and how to utilize them. So let's go ahead and look at option dips first. And these buttons here correspond to the different category plays. So if you click on the crown, the red crown will be core puts. Then if you click the green crown, it will be core calls, so on and so forth. And then if you want to have an AI kind of summarize everything for you and output a response, then you can just do scan all. And this will create an AI response that will give you some insights into what we have in the database as of right now, and things like which tickers are showing up across multiple different categories of play types to compound the logic. So it may take a second for this to reply because I need to probably switch it back to 3.5 turbo because GPT-4 is a little bit on the slow side. But I'm going to go ahead and start going over these one at a time. So for the option dips, that's going to be this emoji right here, or you can select it from this drop-down menu. So we're going to go to SSR option dips. I may still be waiting on GPT to reply. Let me make sure I didn't get any errors here. Yep, no errors. Just taking forever. I'm definitely going to switch that back to GPT-3 because this is taking a little too long. But when it does come up, it's going to give you some insights. So we can see here that we have, I think Uber was on here earlier. Yeah, we have Uber for core puts and high PE play. So that's in the works. But I'm going to go over the actual play categories real quick. So starting with option dips, the option dips basically, what it is tickers that have fallen 10% on the day, and this fact that it falls 10% triggers what's known as the SSR or short sale rule trigger, which prevents shorting the stock on an uptick. So it makes it harder for shorts to short it, and it's just a layer of a metric that would be logical to pursue call options with. So on top of the 10% price drop, you have SSR, which triggers automatically the 10% drop. Then you have what's known as the oversold RSI. It's scanning for oversold RSI, which is going to be 30 or below, and it's on the daily time frame. So not only is it on SSR now, but it's also oversold. And healthcare is not included in this because we all know healthcare likes to do bad things to you and your portfolio. Just due to the fact that healthcare is such an year-round necessity, it's hard to, in my opinion, make play opportunities off of healthcare. So we just throw it out. But anyways, this is you can choose between two different methodologies here as far as how you're going to choose your strike and how far out you're going to go. In my opinion, if you're going to be playing shorter term options like weekly, maybe even a couple weeks or even a monthly option, you may want to, obviously monitor your positions more closely because you are going to lose more value to theta by default because as time gets closer to expiration, theta will decrease, meaning the amount of your option price will be eaten away at time or by time exponentially as it gets closer to expiration. So I like to shoot for theta ranges between negative 0.03 and negative 0.06. And I actually wanted to show you something real quick on the options chain for any option, how you should organize it to benefit yourself when it comes to theta. So let's look at the options real quick. And I'm going to rearrange these columns real quickly. I'm going to put the mid right there, and then I'm going to go and I'm going to get the theta, and I'm going to put it right next to the mid. So essentially what you can do is, when looking at this now, we're on the ticker Uber right now, and if you look at the $70 strike, let me see if I can zoom in. I don't think I can. There's a $70 strike here, and then we go over to the mid, and the mid is 1.22. So if you're a person that's not really all that great with math, then just pull up your calculator, and very easily you can just do this. So if the current theta is negative 0.2024, the mid price is 1.22, then if you put these side by side, this becomes a math problem, just a simple math problem. 1.22 minus 0.2024. And keep in mind, as you just saw, this does change throughout the day. And the closer you are to expiration, the faster and more frequently this number is going to change. And it's not going to change in your favor, because again, as time gets closer to expiration, we should see this number here for every option in the market. More than likely, this is going to decrease, meaning you're going to be losing more value. And I know that's confusing because there's a negative sign here, but you got to think about it like, if theta decreases, that's bad, because that means it's taking more of your money faster. So if we do this math problem, 1.22, which is the mid, or it's 1.24 now, but as it was a second ago, let's just refresh this for a clean example. 1.24 minus 0.2028. So this contract will be worth 1.03 at the end of today if this keeps trading flat, and obviously the mid doesn't change and the theta doesn't change. But as we know, the theta is going to go down as the day progresses, because that's what theta does. So for example, as of right now, the mid's the same price, right? 1.24 minus 0.2029. Now it's going to be worth a little bit less than it was just not even 10 seconds ago. That's how theta works. And that is why, instead of doing something like this at the money, well, yeah, it may seem safe from a price action perspective, because yeah, you're real close to the strike right now. Like it's at, halfway there. But if it trades flat, not only is it going to bleed out your theta, but it's going to bleed out your mid price too, because you have a higher delta. And that's how all this works. It all works together. The higher the delta, the more you're going to be affected by price movement. The lower the theta, the more you're going to be affected by time. So that's why instead of doing, February 16th, I would rather go out to April 19th and look at a strike, maybe 62.5. And this is actually cheaper than the one we were just looking at. But if you look at the theta, much, much, much better. So let's do that math problem again. We're going to go to the calculator, and we're going to do the math problem here on the 62.5 strike, as opposed to the 70 strike for this coming Friday's expiration. So if we do the math here, let's do 1.10 minus 0.0212. 1.1 minus 0.0212. So the price would be from 1.1 down to 1.07. So you lose a little bit less than $3, which is not much, as opposed to, what was it before? So instead of losing $20 right here, because the theta is negative 0.20, which is $20, you're losing $2, just over $2. And then if you were to pick the same strike and you were to pick the 70 strike, you'd be losing 348 minus 0.03. So even then, even though you're still at the money, you're only losing $3 per day if it trades flat, as opposed to that $20, which in my opinion is much better, especially in choppy markets like we're in right now. So hopefully that made sense, but that's how I look at theta. Every time I buy an option, I'm like, all right, what's the last price? What's the mid? And what's the theta? I do a little math. Do I like the number at the end of the day? Is it too high? If it's too low, it all depends. But my personal risk tolerance, I like playing between negative 0.03 and negative 0.02. That's just me. But anyways, that's how option dips work. It's simply just, let's look at the ones that were on the results today. We had leg and PLCE. Well, I can tell you already, I looked at PLCE, and this mofo ripped today, like big style. So that one panned out. But if we look at the daily, this is what we're looking for. So PLCE on the day, it dropped on Friday of last week. Friday of last week, it dropped 36%. So obviously that's well within the SSR. RSI is oversold, and then look, the RSI boom corrects. And this is one of those things where it's not technically core logic because it doesn't come right after earnings. This is if those of you that have been in the group for a while, I don't know if you remember, but we would always discuss about the gappers that would occur in between earnings, and that's what this just did. It's in between the earnings, about halfway in between, and it gaps down. So it's just another way to take advantage of those quick gap downs followed by the reversals, which, as you can see today for PLCE, worked out very good. It's up 21%. The options on it are up, let's see, not bad. I mean, not bad at all. 150 to 200%, which, not bad. So that's the option dips. If we look at core puts, I'm not going to go over core because I'm assuming everyone in the group knows what core is. If you're not sure, there's tons of videos on it. It really hasn't changed much other than the fact that instead of the minimum price being $5 as it was a long time ago, I've been slowly, incrementally increasing that higher and higher because I've noticed that lower priced tickers when it comes to core options don't really pan out as well. I'm pretty sure it has something to do with not as much strike prices in the chain, therefore not as much liquidity, something along those lines. But just based on observation of the last few years, it seems to me like between 10 and 15 is that good threshold to set for the closing price. So keep that in mind, but we're going to experiment with 15 for now. DTCC just got a feed. And all important notices to the DTCC we'll post here, by the way, in the DTCC channel. So core, it's the same as it's always been. Oversold RSI, overbought RSI, daily gaps. Earnings has just occurred. That way, you get IV crush. But something to add and note about core is if you take the theta logic that I just explained a second ago and you apply it to core. So let's just pick one of these here. Let's pick Disney. And we go to Disney and we check it for core criteria. Okay, it's got the gap, it's got the daily earnings, it's got the oversold RSI. MACD starting to flatten there on the daily. But let's look at the options chain. So normally, everyone would play somewhere around 16th of February to maybe the 23rd, maybe even going into the 1st of March. But if you take that same theta logic and you expand it out and you go a little bit further in time and you look for those lucrative theta values between those numbers, 0.02 and 0.03, that puts us right at 105. So we have a little bit over 2 months here for the price to go down just $5. We know the RSI is overbought. We know they just had earnings. And if we look at this and we look at the theta and we do that math problem again, we see 1.92 minus negative 0.02. So we're losing between $2 and $3 as of right now. But way better than if we were to pick this week and pick an at the money strike at 110, which again, it's a tricky situation because in your brain, it would make logical sense to go with the shorter term, closer to the money strike, because if it does go in the money, then you're going to be making very good profit. But that's where you got to weigh in the risk, because if it doesn't, and it may not, but if it doesn't, you're going to lose significantly more money than you would if you were to go out here and play just $5 lower than it is now. And your risk goes way down and your profit potential stays intact because you're buying all that extra time on the clock. So I hope that makes sense, but that's basically the logic behind it. Core still works, obviously, but I think the success rate may go up if you just expand out that time horizon just a teeny bit, maybe go a little bit further out of the money and get those nice theta values and just monitor them as you build your position. Because I would much rather lose $2 or $3 a day waiting on the inevitable to happen than sit there and lose $14 to $16 a day, which is a significant percentage of the overall value. So that is core with the added theta logic if you choose. It's always a balanced mix. You're either going to go with a shorter term expiration with more profit potential and loss potential, or a longer dated expiration with, in my opinion, the same profit potential, but you're giving yourself more time for it to come to fruition, which, as we all know, looking at the RSI, every time that it goes up above the $70 mark, it always comes down. So you're not wrong, it's just the timing. So that's core, same as always, basically. Next, we have earnings today. That's just self-explanatory, tickers with earnings today. And then we have the top of the trend. This one is specifically looking for tickers that have been increasing in price while decreasing in volume. And that's what the price up, vol down means. Price up means it's been increasing in price for the last 3 days. Volume down means it's been decreasing in volume for the last 4 days for GE, APH, and Hub. And then also it's checking for, again, oversold RSI, because when you're playing options, I mean, RSI is one of the most critical components, in my opinion, to any strategy. It's got to be involved. That's just my opinion. But we're also scanning for that. No healthcare, price above $15, and that's basically it for that. And then the same is going to be true when I implement the bottom of the trend. And yeah, that's basically it for top trend. We also have the overvalued PE ratio, which again checks for the RSI. This one is going to be overbought. We're looking for specifically PE ratios that are greater than or equal to 40, and non-healthcare, of course, price greater than 15, and earnings are at least 20 days away. So this is for those of you that are looking to play earnings or something along those lines. These are tickers where you're getting overbought RSI, upcoming earnings, knowing that it's overvalued heading into earnings. So that's just another logical approach to this. But always, I would highly recommend paper trading these at first, especially if you're unsure about it. But it's just offering a lot of different avenues of ideas or attack on the market. And then we have 5-year low revenue. These are going to be tickers that have reported the lowest revenue within the last 5 years. I may need to fix that one. Okay, here we go. And that just has the ticker names. You have ADT, FMC, BAM, K, SDX. These are all tickers that have reported 5-year low revenue figures. And then I think that's basically it. Then we have the SMA 200, SMA 200 Death Cross, Bullish Cross, but it's a work in progress. I just wanted to go over this so y'all could get some insights as to what this is, what it does, how you can use it to make money in the markets. I've already made over 500 today playing GE and a few others. Let's see at GE right now. Okay, GE's pumping right now, perfect. So yeah, it's just a managing game. You have a 1 minute gap right here. But yeah, again, I don't really look at charts. The only time I look at charts is to confirm what I want to see on the daily. But as of right now, I'm playing GE, and I'm just waiting. There's a lot of Fed data to come out this week. So yeah, I mean, in my opinion, the theta has been what's working for me. Just being aware of what it is, watching it. If it goes above that $3 a day loss threshold, just, that seems to be, based on what I've seen since I've been doing this, is when it gets to that $3 mark, somewhere along between 3 and 4 is when I usually sell for profit. So I just wanted to point that out. But none of this is financial advice. If you want to join the Discord and see what it's about, there's free trials now available, I believe, on every avenue that you can join. The Discord link is different as of right now. We have to get, I think, 1,000 members in the group before I can get a vanity URL again. But I'll link that in the description below. Hopefully that helped the group members, and stay gay.